Listen to me. Are you listening? You are at a point in your life where you cannot afford to be wrong about where you put your money. You've worked too hard, you've saved too long, and you've sacrificed too much to play games with your financial security. People come to me all the time and they say, "Susie, I see these commercials, I see these cafes, I see these credit cards everywhere. What is Capital One? Is it a real bank? Is it just a credit card company? Is my money safe there?" And I get why you're asking. Because back in our day, a bank was a brick-and-mortar building with a giant vault and a manager who knew your name. Today, everything is digital, everything is fintech, and quite frankly, it's confusing. But confusion leads to fear, and fear leads to bad financial moves. So, let's get real about what Capital One actually is and what it means for your retirement. What is it, really? Capital One is what we call a diversified financial holding company. Now, don't let those big words scare you. All that means is that they are a massive umbrella that owns several different types of businesses. Most of you know them for their credit cards. That was their bread and butter when they started back in the 90s. They were the ones using data and information-based strategies to figure out who should get a card and what the interest rate should be. But they didn't stop there. They grew. They bought up other banks. They moved into auto loans. Today, Capital One is a top 10 bank in the United States. They are a national association. You'll see NA after their name. That is a very specific legal designation. It means they are a federally chartered bank. They aren't some fly-by-night app living only on your phone. They are a regulated, massive institution. The Great Discover Shift. Now, I need you to pay attention to this because it's happening right now. Capital One is in the process of acquiring Discover Financial Services. Why does this matter to you? Because it changes the landscape. Usually, banks like Capital One rely on Visa or MasterCard to process their transactions. But by buying Discover, Capital One is becoming its own network. They are joining the ranks of American Express. They will own the bank and the plumbing that moves the money. For you, this means they are becoming more powerful and more integrated into how the world spends money. The fear, is your money safe? This is the question that keeps you up at night. Susie, if I put my life savings into a Capital One 360 savings account because the interest rate is high, and the bank goes under, what happens to me? Listen to me, Capital One is an FDIC-insured institution. That is the must-have for any person in or near retirement. Your deposits, your checking, your savings, your CDs are insured up to $250,000 per depositor, per ownership category. If you have a joint account with your spouse, that's $500,000 of protection. One thing you need to be careful about during this merger, if you have money at Discover and money at Capital One, eventually those limits will be combined. You have to watch your balances. Do not exceed those FDIC limits, because that insurance is your only true safety net. The cafe culture versus traditional banking. You might be walking down the street and see a Capital One cafe and think, what on earth is this? Am I going to a bank or am I buying a latte? This is their strategy. They have moved away from the old-fashioned branch model. They don't want thousands of expensive buildings with tellers behind glass. They want a digital-first experience. They want you to use the app, use the website, and if you need to talk to someone, you go to a cafe. For some of you, this is great. It keeps their overhead low, which is why they can often offer you higher interest rates on your savings than the big three banks that have a branch on every corner. But for others, the lack of a traditional branch is a deal breaker. If you are someone who needs to walk in and hand a physical check to a human being every Tuesday, you need to know that Capital One might not feel like the traditional bank you're used to. The problem, the credit card trap. Here's where I have to be tough with you. Capital One is a credit card powerhouse. They make a huge portion of their money from interest and fees. In retirement, debt is the ultimate thief. It steals your freedom and it steals your peace of mind. Capital One is very good at marketing cards with miles and cash back. And if you are someone who pays your bill in full every single month, then fine, enjoy the rewards. Use them to visit your grandkids. But if you are carrying a balance on a Capital One card while also keeping money in a Capital One savings account, you are making a massive mistake. They might pay you 4% on your savings, but they are charging you 20% or 25% on your card. You are losing money every single second that clock ticks. Your actionable takeaway. So, what do you do with this information? Check your interest rates. If your old-fashioned bank is paying you 0.01% on your savings, you are being robbed by your own loyalty. Capital One is a legitimate, safe place to get a much better yield on your cash through their 360 savings accounts. Verify your limits. If you are using them for your retirement cash, make sure you stay under that $250,000 FDIC limit. If you have more than that, spread it out. Audit your debt. If you have a Capital One credit card balance, pay it off today. Use your savings to do it if you have to. You cannot outinvest a 24% interest rate. Embrace the digital. Safely if you decide to bank with them, you must use their security features. Turn on the two-factor authentication. Use the card lock feature in their app. They have great tech. Use it to protect yourself. Capital One is a modern, stable, massive financial institution. It's not just a credit card company, it's a powerhouse. But it is a tool. And like any tool, if you don't know how to use it, you're going to get hurt. Be smart with your money, stay safe, and remember, you have worked too hard to settle for anything less than total security.